If you could save 5, 10, 25, even $100,000+ on your tax bill by watching this one video, would it be worth it to you? Hi, my name is Greg Rodriguez, and I'm a CPA at GJR Consulting, where we help small businesses just like you with smart financial strategies. And in today's video, I'm going to show you the top business deductions that you may be missing out that could be worth significant tax savings and profits in your business to help you grow. Let's talk about what a deduction is, and why they're so important and the difference they make in your business when you have great record keeping. We all know that, we open up a business because we have a thought of an idea, as there's a service or there's a product that we want to sell. And in order for us to do that, we're going to spend some money, whether that's, startup costs or just ongoing operations in buying the materials or the supply or the technology to deliver that product or service. Those are deductions. And if we don't understand what those are and how they work for our specific business, we're going to miss out on a lot of opportunity, which means paying more taxes, right? Because the strategy here is, how do we minimize taxes legally through the money we're spending deductions? And I want to highlight some of the big ones that a lot of people miss. One of them is the QBI deduction, Qualified Business Income Deduction, which is 20%. And this is a big one because it's not just, that easy of, let me take 20% of a flow-through number, right, from my partnership, my sole prop, or my S Corp. There's a balancing here when you start having an S corporation of, how much do I pay myself versus how much do I flow through to get the maximum benefit of this 20% QBI deduction. The other one that I want to talk about is the business vehicle expense. I talk to business owners as new clients that come in all the time, and we get into, their P&L, and I ask them, where's the auto expense here? And they're like, well, we don't have any. Well, what kind of vehicles are you using to deliver or to, visit clients? And they're like, oh, I use my own personal vehicle. That's a deduction, right? We just have to do one of two methods: track our mileage, right? And make sure you're tracking your mileage on a just-in-time basis. You went somewhere, you're tracking it, you went somewhere else, and you're tracking it. Don't let this stuff accumulate because it becomes a nightmare. So you track your mileage and you get a certain amount of pennies, right, to the dollar for each mile that the IRS sets every year. And that'll be your deduction for your vehicle. The other option, which I see in my practice over 25 years, that gives you probably a better deduction, is the actual expense method, right? And in that method, we're going to be deducting everything: your fuel, you got new tires, you repaired your car, your licensing fees, all of that stuff gets added up, and you take a portion of the percentage of personal use of the vehicle versus business use. That usually renders a much higher deduction. The third one I want to talk about that's quite elusive, especially for small business owners, is the home office deduction. And this one's a big one because we're working from our house. The government says you must allocate a specific space. You just can't say I'm randomly here and there. There's a specific space in my home that is for business. And you get to deduct that portion of it anyways, right? So if you got a 4,000 square foot home and you're using 1,000 square feet specifically for your business, well, that's 25% of a lot of things that you can deduct in that home, right? Indirectly, mortgage interest, property taxes, repairs, you can depreciate. There's a whole bunch there. And of course, that specific 1,000 square foot, anything you do specifically for that, for your client experience, that's a direct 100% charge, right, expense. So these are the three big ones that I see that get missed by small business owners all the time, and even CPAs. So take a look at your P&Ls and make sure you're looking out for these deductions. They all add up and to save you a lot of money on taxes and increase your profits. Let's make sure that you have some of the common deductions, right, that you're taking advantage of right away from day one. And one of them is meals expense. So today in 2024, meals expense is up to 50%. That's all you can deduct. But here's how it works, right? The government requires you to do a little bit of homework with meals. They'll give you the 50%, but again, it has to be ordinary and necessary. What does that mean? So you can't take a client out. And by the way, it doesn't have to be a client. It could be a client. It could be a prospector. It could be one of your vendors, one of your suppliers. You're talking business is the key thing here. And the homework that you have is when you get that receipt, we know that usually the receipt has where you ate and of course, what you ate and the date, right? We want to make sure what year this is all happening. The two pieces that you have to do is, who were you with? Who was that, supplier, vendor, employee, right? You need to document that, and you need to document what was the discussion? What was the purpose of this meeting? Something to keep in mind. Remember, we're gonna use this term a lot: ordinary and necessary. If you've got a receipt and there's, 20 shots of tequila or whatever your favorite alcoholic beverage is, that might not be necessary, nor is it ordinary in the course of a business. So a lot of that might be disallowed. So again, understand what the deduction means and make sure you stay within the limits so that you can actually take the deduction instead of that thing being disallowed. Another deduction that we see that is commonly missed is interest expense, right? So when you're purchasing a vehicle, if you bought it outright cash, fantastic. But sometimes most business owners, they finance the vehicle, right? And in that financing, there's an amortization, right? When you make a payment of $1,000 a month, part of that is to, towards the payoff, reducing the debt. But part of it is part of the terms where we're going to loan you, we're going to give you this car, we're going to finance it, but we're going to charge you 5% a month on the balance every month. So an amortization schedule is going to be a great tool for you. If the bank doesn't give it to you, right, the lender, you want to create it for yourself, because every time you make a payment, you're going to refer to that amortization table. It's going to tell you, okay, this much goes, right, to reduce the debt, and this is the part that I want to see on my income statement, because it's going to reduce that income, right? It's going to reduce that income, which means we're reducing taxes, keeping more money in our pocket. Another one that's missed, small business owners, startup expense, right? We wake up sometimes, we say, hey, I'm going to go out on my own. I'm going to blow this W-2 job. I'm going to do this and I'm going to do it better. And we start spending money. We start researching. We start maybe hiring attorneys, CPAs, so that we can start looking at budgets, numbers, and setting up, a new entity for this business. All of that is called a startup because we're not in business yet, right? We haven't even opened up the entity, but this is money coming out of your pocket. And we want to make sure that you're capturing all of that and not wasting those dollars, because when you open up that entity, you're going to record that, right? Your accountant's going to record that and say, hey, so-and-so put $5,000 or $10,000, to start up this company. And you're going to be able to write off $5,000 of it in year one. The rest of it, again, if you spent $10,000, gets amortized over the next 15 years. But it's a big deduction. It's a big deduction that people miss because we're all spending money. When we have that thought or idea of we're going to go out on our own, we're spending money to get it going. So remember, all of that is going to be deductible and it's going to help you out a ton. I want to share a story with you about a client. This actually just happened this year. And, there's a little bit of a struggle with cash flow. And so we started unpacking where's the money going. And what we discovered is that on the balance sheet, right, all the payments that they were making for equipment, and this is a heavy equipment intense company, and all the payments were being applied to the debt. And what they didn't see is that there was about $67,000 a year in interest. That's about $6,000, $5,500 a month that's going away, and nobody was looking at it. Nobody is deducting it, right? So when we get clients like this that come to us that, they have a struggle and we unpack their numbers, it's just an eye opener. And the truth is they begin to feel so much better because they begin to understand the cost of borrowing and things like that. So listen, business owners, pay attention to your numbers, get organized, get structured, record keeping, and it's going to be amazing when you start understanding how to track the money that's going out, how to use it so that you become a much stronger, more powerful business. For more personalized guidance, contact GJR Consulting. Let's make sure you're not leaving any money on the table, not just tax season, month to month to month, right? Tax season is just an opportunity to say, listen, what happened in my business this year? You want to make sure you're on top of this every single month so you can make the adjustments. It's hard to fix things after 12 months. Let's get in touch. Let's see how we can help you save more money, become more profitable, and build that great business that you have in your mind.